Hello friends, welcome back to our channel. Here, we will keep sharing as many Forex educational videos as we can to help you level up your trading. Dear viewers, in this video, we decided to examine the cup and handle pattern, which is one of the most famous trend continuation formations. I will try to explain it to you using the simplest and most easily understandable method. I hope this tutorial really sticks in your mind. And if there is anything you are unsure about, don't forget to share it with us in the comments. As you know, we always try to answer your questions. And please, don't forget to subscribe to the channel and give the video a like, okay? Before we dive into the topic, I want to remind you of something very important, dude. Everything I explain in this video, let me stress this, is purely for educational purposes. We are here to learn technical analysis and understand the market. So nothing I talk about should ever be taken as financial advice. Don't enter any trade without doing your own research and managing your own risk. I am just sharing my knowledge. The last decision is always yours, alright? Alright then, now that we've made that reminder, let's start examining the cup and handle pattern closely. In this video, we are going to cover the following topics. 1. Introduction. 2. The cup section. 3. The handle section. 4. The breakout. 5. Target and stop loss. 6. The logic behind the cup and handle. 7. Real chart examples. Now, let's get to the main point. What exactly is the cup and handle pattern? The cup and handle is a pattern that appears on charts and often signals the continuation of a bullish trend. The price first drops, then gradually recovers, forming a rounded, curved bottom. After that, there is a small pullback, as if the price is saying, "Let me take a little break." These two parts, the rounded bottom and the small pullback, together form what we call the cup and handle. It is a popular pattern because it usually shows that the market is gathering strength before the trend continues. If you are wondering where the name of the cup and handle pattern comes from, guys, it is entirely based on its appearance. When you look at the chart from a distance, that rounded bottom looks just like the inside of a cup. Then, the small pullback in the price looks like the handle of the cup. So, there is actually no technical term here. It is called that simply because its shape literally resembles a cup and a handle. Very simple, a name that perfectly describes what you see. So why is it so popular? Because it's both simple and clearly shows market psychology. It is a very clean structure that illustrates how traders first recover from selling pressure, gradually regain confidence, and then, after a small pause, prepare for a strong upward move. Once the pattern is complete, the price almost always continues to rise from where it left off, often even stronger. That's why it is a pattern closely followed and considered reliable by both beginners and professionals. Now, let's take a closer look at the cup part. Guys, think of this section as the main body of the formation, basically the cup itself. So, let's check out what you need to know about the ideal shape of the cup. How should the rounded bottom look? The bottom of the cup actually shows that the price is slowly recovering. In other words, the bottom part of the cup tells us how prices behaved during the correction. The important thing here is that the bottom shouldn't be sharp. The price shouldn't look like it dropped suddenly and then bounced back immediately. It should be more calm, curved, and smooth. This kind of shape is considered much healthier because it shows that selling pressure in the market is easing and buyers are gradually stepping in. Should it be a V shape or a U shape? You always want a U-shaped bottom. With a V shape, the price drops really fast and then jumps back up just as fast. That's usually not a healthy recovery. It looks more like a sudden reaction. Those sharp moves tell you the market is super volatile and the formation might not be that reliable. But a U-shape, that's the good stuff. It shows the price is really forming a bottom, the market is taking a breather, and things are starting to balance out. That's why traders always trust the U-shape more in a cup and handle. How long should it last, and how deep should it go? The length of the cup really depends on the market, but here's the idea. The more controlled and patient the bottom forms, the stronger the formation. A too shallow bottom isn't great, and an overly deep one isn't either. If prices drop too far, it could signal that the uptrend is completely over and a new downtrend has started. Remember, this is a continuation pattern. Ideally, the price makes a reasonable correction first and then slowly recovers. As long as the duration and depth aren't extreme, basically, if everything happens naturally, the formation works much more reliably. Now, let's move on to that small but important part, the handle. The handle, in a cup and handle pattern, is actually the part where the price takes a little break. After the recovery in the cup, the market usually doesn't start running immediately. It first makes a small correction. This correction shouldn't be too deep. It usually looks like a 1 step back, 2 steps forward, kind of gentle pullback. The handle is a small pullback that forms in the upper half of the cup. And this is very important. The handle should not go all the way down to the bottom of the cup. If it goes too deep, it stops being a handle and breaks the formation. The handle shows us that the price is taking one last pause before moving higher. In this part, the price often forms a consolidation or a narrowing structure. In other words, the candles get smaller, movements calm down, and the price doesn't swing too much up or down. It is like everyone is waiting and thinking, okay, what are we going to do now? This kind of tightening is exactly what gives the handle its shape. Volume behavior is the best complement to the cup and handle pattern. When the handle forms, the way volume behaves tells us how reliable the formation is. We want the volume to be weak during the handle. Why? Because this shows that while prices are pulling back, that is, while the handle is forming, traders are not really selling aggressively. It is just a small correction. We see a similar calmness on the volume side. Trades decrease, the market quiets down. This is normal because big players usually wait for the breakout. So, decreasing volume during the handle is actually a healthy sign. When the price breaks above the top of the handle, we expect volume to increase again. That's when we see if the formation really works. Guys, the really important part is, of course, the breakout. The breakout is the most exciting part of the cup and handle. It happens when the price moves above the top of the handle, clearly showing that the squeeze is over. Usually, we can spot it with a long candle, higher volatility, and often a noticeable increase in volume. It is like the price is saying, all right, I'm going now. The most reliable way to confirm a breakout is if the price closes above the handle level. In other words, we need to see the price pass that resistance and hold there. Just a spike that quickly falls back doesn't count. The candle's body closing above that level gives us a clear signal. On top of that, the best proof that the breakout is real is volume. When the breakout happens, the trading volume should rise noticeably, even spike. If there is no volume, be cautious about that breakout. Strong volume means big players are supporting the move. The biggest trap when trading based on the cup and handle pattern is false breakouts. Sometimes the price looks like it's breaking above the line, but then it immediately falls back. This usually happens with low volume, indecisive candles. In these cases, it's really important to check if the price actually closed above that level. If the volume doesn't support it, the candle is weak, or the price quickly falls back into the handle, it's most likely a fake breakout. That's why the safest approach is to evaluate both price action and volume before saying, it's broken. Sometimes, after a breakout, the price comes back to test the old resistance as support. If it passes that test and starts moving up again, that's a much more reliable signal. So, guys, the breakout moment is both very exciting and one where we need to be extra careful. Always check the close and the volume to make sure the breakout is real. So, how do we calculate the target? In a cup and handle pattern, figuring out the target is actually pretty simple. We measure the depth of the cup, that is, the distance between the top of the pattern and the bottom. Then, we add this distance to the level where the handle breaks out. That gives us the theoretical price target. In other words, the pattern is basically saying, this is how far I expect to go. Stop loss is a bit more delicate. Short-term traders often place it just below the breakout point. But traditionally, the safest spot is under the bottom of the handle. If the price goes below that, it means the formation has failed, and there is no point in forcing the trade. Conservative traders might put it a little below the handle support area, while more aggressive traders may use a tighter stop. But the general idea is this: if the price falls below the handle, accept that the scenario isn't working and cut the loss early. The logic behind the cup and handle pattern is really all about reading price psychology. This pattern shows us that a strong uptrend is taking a short breather before continuing its path. The price first drops, then slowly recovers. During this recovery, the market builds confidence and can get a bit overheated. When prices are at that rounded bottom, the seller's strength fades, and revaluation begins. Buyers gradually come back and push the price toward its previous high. That's how the calm, rounded cup shape forms. This recovery proves that the market still wants to move up. When prices reach the top of the cup, the last hesitant sellers appear, wondering, will it drop again? This creates a small pressure. Then the price takes a little pause, a gentle correction, that's the handle. But this time, selling is limited. You can think of the handle as the final shakeout of indecision in the market. It shows that the market no longer supports a drop, just cleans up a little, and serious buyers are waiting. So why does this formation work? Because it reflects a very natural behavior. The market finds a bottom, recovers, experiences one last profit-taking, and then strengthens and continues the trend. Essentially, you're visually seeing how the big players accumulate positions on the chart. That's why the cup and handle is both simple and considered a very strong formation. It shows that confidence and momentum are coming back to the market. The key reason it works so well is that it demonstrates the strong trend's desire to continue. Now, let's see this on a real chart. Look here. The price first creates a strong uptrend. Then it slowly pulls back, forming that rounded bottom we call the cup. Following that, a small handle forms, meaning the price takes a little break and consolidates. And then, the moment it breaks above the top of the handle with a strong candle, the trend continues right from where it left off. Watching this move on the chart really shows the logic of the pattern. The market recovers, takes a short breather, and then keeps moving up. This pattern doesn't tell us the trend is over. It shows that the market just paused and that the strong move will continue. It is a perfect trend continuation signal. Now let's go step by step and see how we set our entry, stop, and target on a real chart. Look here. The price first forms a nice cup structure. Then, in the handle, there is a small squeeze. The breakout happens right at this area. The top of the handle is clearly broken with a strong candle. This is exactly our entry point, right at the breakout level. The stop loss in this example is placed just below the breakout level, not under the handle. This way, if the price pulls back after the breakout, it shouldn't fall below the breakout zone. If it does, it usually signals a failed breakout, so the stop gets triggered. This keeps risk management tight and avoids placing the stop too far from the position. The target is calculated by measuring the depth of the cup. We take the distance between the top and the bottom and add it to the breakout level. This gives us the theoretical price target. Look at the chart, it lines up perfectly here. So, entry is here, stop is here, and the target is up there. This way, we can trade the pattern both safely and in a well-planned manner. Hey guys, if you enjoyed the video, make sure to hit that like button. If you are not subscribed yet, go ahead and click that subscribe button and tap the little bell so you do not miss any of my new videos. Your support means a lot to me. If you like this kind of technical analysis content, do not forget to like the video and subscribe to the channel. Drop a comment about which pattern you want to see next and I will cover it in the upcoming video. Take good care of yourselves and I wish you lots of profits. See you in the next one. Goodbye.